Eyo YouTube, how are you doing? My name is Stijn and welcome to my YouTube channel. As per request from user InsigWow, we're doing a video on how you can do your due diligence and actually research a company. I really hope I can give you guys some advice you can immediately start using, and I especially hope I can explain to you how to value a company's intrinsic value. We'll first start out with how to find good companies and what criteria they need to hit before I would start researching them myself. After this, we'll try to determine how to quantify a moat or a competitive advantage, and we'll talk about the importance of said competitive advantage. Thirdly, we'll look at some financial metrics that I find important. Fourth, we talk about what I look for in a management team. And lastly, how to predict where a stock could go in the future and then try to determine what's fair to pay today. Let's go. Personally, I'm part of a lot of Reddit pages. For example, r/value investing, r/penny stocks, r/Canada penny stocks, and maybe a weird one, r/Wall Street bets. On these forums, I read almost all DD pieces that are published. This way, you and I can leverage the research those guys are doing and find tons of new and intriguing companies. Hopefully, before they actually skyrocket. If this company sounds interesting to me personally, and I internally feel the need to learn more about this company, that's a really good sign. I should become enthusiastic early by what they do, the problems they solve, the sectors they're in, etc, etc, etc. And if I'm not interested personally by what they do, we skip this company and find another one. In this stage of research, I only focus on two parts. And the first one is to look for a competitive advantage. We'll do a deeper dive into this one a little bit later. And secondly, do I understand this business? And if I don't, could I understand this business? We'll do a deeper dive into this one now. Everyone has talents, areas of expertise and experience. That's your advantage, your edge on everyone else that's investing. So let's say you work in IT. You know a lot about software, hardware, etc. Information the average Joe doesn't have. Besides that, you use so many different products on a daily basis. You use your car, cleaning supplies you use, the groceries you decide to actually pick up. You're an expert in so many fields. Please leverage that capability. Make best use of the knowledge you already have and invest in what interests you. Please do not invest in things you do not understand. For example, pharmaceutical companies that do not even have a product yet and are waiting for FDA approvals. So, invest in companies you understand or could understand and know where your boundaries are. Now the most important part of research. What makes this company so special? What is their competitive advantage? What is the moat around their castle that keeps competitors away? It's really hard to learn this from a book or a video. You need to get a feel for this in the real world. But we'll try to get a better understanding in this video. When researching a company, you need to understand what it is that makes it so special. Why is the one you are investing in significantly better than all the other companies in this field? A competitive advantage or moat can be many things. It can be knowledge-based, for example patents or awesome technologies. It can be price-based, they're simply just the cheapest ones around. It can be brand-based, people just love buying Nike. And it can be switching based. People are just so ingrained in Apple's ecosystem, they cannot leave. It can be so many things, but you need to quantify the competitive advantage in the company you're researching. And you need to be able to explain this to a toddler in 2 minutes or less. We'll look at an example for this one. Nouveau Monde Graphite. They have a couple of competitive advantages that are laid out in the videos I did on them. But we'll talk about them shortly here. The first one is that they're low cost. They have one of the highest margins in graphite worldwide. The second is that they're the first fully electric, carbon neutral open pit mine in the world. This is a massive selling point for any EV maker out there. And the third is that they're jumping into a sector that's really hard to penetrate. And that's growing exponentially because of the EV production coming up. A mine takes years to start up and they have a 5-year advantage to anyone trying to mine graphite. See, this company has 3 really large competitive advantages that makes them so attractive to invest in. Sure, competitors will come around, but will they be fully electric and carbon neutral? Will they also be low cost as Nouveau Monde? And will they catch up the 5-year head start Nouveau Monde has. It's really hard to compete with Nouveau Monde, and that's exactly what we want as investors. Depending whether you're investing in a startup company or a company that's been around for years, there are different metrics that are important to each. We'll start with a company that's been around for years. I normally go on macro trends and look for a company we're researching. Let's look at Regeneron, which we did a video on a little while ago. Let's first look at revenue. Is it growing consistently? For the last 10 years, except in 2019, this company has been growing like an absolute champ. And this is what we want to see in companies that we invest in, consistent exponential growth. And if it looks more like this, which is Royal Dutch Shell, maybe you can't really be expecting them to grow exponentially for decades to come. We want to see an increase of 10% or more in revenue for over a decade. But 1 or 2 bad years are totally forgivable. The next one we look at is EPS, or earnings per share, since this one is really important to determine a fair valuation. Has it been growing consistently and greatly? Regeneron is again a great example, with an average increase of 30% every year. And has it been slowing in recent years? If so, it might not be a great investment now. And as you can see, Regeneron is still growing at around 45% year to year. So we're totally fine on this one. Again, 10% for over a decade is the benchmark to hit. The last one we're looking at is debt. Just look at their current long-term debt. For Regeneron, it's around $2.7 billion as of right now. Then divide the debt, the $2.7 billion, by their net income per year. So 12 months ending December 31, 2020 for Regeneron, which will be $3.5 billion a year. And this formula results in 1.77 years. Therefore, Regeneron could pay off all long-term debt in just 0.77 years of profits. My personal tolerance to that is that below 3 years is a great position to be in, and below 5 years can still be quite okay. Above 5 years and I'm a head out. These financial metrics are way more important for a company that's been up and running for years, so more of a blue chip company. When investing in a smaller company or a startup, you maybe cannot expect them to be growing so consistently for so long already, and therefore should forgive their shortcomings. But in doing so, you're accepting more risk. What would we look for when deciding on a management team for our dream company? For my dream company, I would like a well-diversified team with tons of experience in the sector they're operating in. I would like my man or woman at the front of this team to have large goals. Goals to turn this company into one of the greatest on earth. Make it profitable, make it morally sane, and change lives for the better. Said CEO should also be honest in the communication to us, the shareholders, and I'd like them to have some serious skin in the game. If they do, for example, hold a large part of the company's outstanding shares, they would be just as interesting as us shareholders to increase the value of the company, therefore increasing the share price in the long run. To get to know all this, I would advise watching interviews, reading anything the company is publishing, watching their presentations, etc. etc. This all to get a feel for the goals of the management, their moral compass, and their view on us shareholders. Are they constantly diluting the value, or are they actually increasing the value of the company? There are almost infinite ways to calculate a fair price for a company, but in this video we'll be discussing one of the easier ones to understand. Please keep in mind this one is great for the larger companies, but doesn't really work on unprofitable businesses. The formula we'll be looking at is still one used by Warren Buffett, Phil Town, and so many other great value investors. Some may recognize it as the margin of safety formula, and it goes like this. Take out your calculator for this part. And now take their current EPS or earnings per share of the company we're researching. For Regeneron, this would be around $30.52 per share, according to Yahoo Finance. Now we need to determine how much this bad boy will grow in the next decade. And this is where the financials we researched earlier come in. Has the growth been slowing down and the average is around 30% for the last decade? Maybe you should take around 20% for the next decade. Or has it been increasing? Maybe you should add a little. This is the hardest part of the formula and it's quite important, but you can always recalculate. So just try, get a feel for things, just try. In my opinion, Regeneron has been slowing down just a little, so we'll take 20% as a growth rate for the next 10 years. Well, the mathy part. Take their current EPS, $30.52 for Regeneron, and multiply it by 1.2, which is the growth factor. And 1.2 is to the power of 10 because of 10 years. This gets us to a future EPS of 189 in Regeneron's case, So in 10 years, Regeneron could reach an EPS of $189 according to our calculations. Cool. But now we need to determine what is a fair price to pay for this EPS. Well, for PE ratios, there's two things you could do. The first one is just multiplying their growth rate by 2. So for Regeneron, this would be 2 times 20 equals 40, so a PE of 40. The second scenario is to look at the averages in the past. Around 25 to 30 sounds reasonable for Regeneron in this scenario. And to be conservative, we'll take the lowest of these two, so a PE of 25. So again, the mathy part, multiply the future EPS by the future PE. So $189 times 25 for Regeneron leads us to a future value of around $4,700. Awesome. So Regeneron could reach up to $4,700 in the future. So now we need to determine what is fair to pay for this future value today. I like to discount this at 15%, which is my minimum return on investment. So we take the future value and divide it by 4.05. 4.05 because 1.15 to the power of 10 equals 4.05. Therefore, fair value today would be around $1,170 for Regeneron. But to really secure the attendees, we take another half of this price as a margin of safety. Therefore, we get a price we would really like to pay for Regeneron of around $580. You should always take a margin of safety, always. This is what ensures the attendees and automatically error corrects any mistakes you could have made in the calculations or research. If you take a margin of safety of 50%, almost all your guesstimates can be way off and you will still profit. If you have any questions about this part, the formula, or any other part of the video, hit me up down below and I'll do my best to explain it to you again. There's still so much more to explain, more details I would like to give, more experience I would like to share, but it just wouldn't fit in one video. So maybe if you hit 1,000 subscribers one day, I'll do a series on this and I'll try to explain each part in even more detail. Subscribe and stick around if you would like to see that. Also, comment down below what you want me to talk about more specifically in that possible series. I really hope you guys found this video useful and enjoyed it somewhat. And if you did, please give it a like and maybe even subscribe. Comment down below what you want me to talk about next and I'll see you guys in the next one. Peace.